When we expand on financial ratio analysis, one of the measures that we talk about is the DuPont identity. The DuPont identity extends out the return on equity formula to look at the components in what goes into return on equity. The basic formula for return on equity is net income divided by total equity. However, we can look at the different components of the DuPont entity. If we take the profit margin times the total asset turnover times our equity multiplier, that gives us the return on investment. So we have the profit margin, which is net income divided by sales, total asset turnover, which is sales divided by total assets, and then our equity multiplier, which is total assets divided by total equity. We take each one of those items times each other. It's another way to calculate return on investment. It tells us that whether or not a firm can leverage up its return on investment by increasing the amount of debt that we have. We're going to talk more about the amount of debt to equity that a firm carries as part of their capital structure in a future chapter. When we're using the DuPont identity, we're taking the various components, such as profit margin, which is looking at our operating efficiency. How well do we control costs versus our income? So our net income is what's left over after we've paid all of our costs. If we have lower costs, we have a higher profit margin. Our total asset turnover is a measure of our asset use. How well do we utilize our assets to generate sales? And our equity multiplier is a measure of our firm's financial leverage. So what is our debt to equity ratio? How much of our finances or our assets are paid for by long-term debt, and how much are paid because of equity businesses, investments in the business. We look at the DuPont entity of our company from the textbook Prufrock, and if we take profit margin times the total asset turnover times our equity multiplier, we get a return on investment of 18.06. That does match the return on investment that we get when we divide total or return on equity. That matches the return on equity that we get when we divide our net income by total equity. But this also helps us see how we can change different measures within our company by maybe increasing our profit or changing our total asset turnover or changing our debt structure that could change our return on equity results. The next ratios that we're going to talk about are growth ratios. So these growth ratios are dependent based on the amount of cash dividends we pay out and how much of our net income we retain. That's our retention ratio. How much of the net income we retain for internal use. So one of the reasons that companies retain net income is to grow and pay for things that they're doing. So the internal growth rate is if we're looking at how much we grow based on the amount of retained earnings, then that's our internal growth rate. Sustainable growth rate is how much we can grow based on the amount of debt and equity we're willing to take. So that says that we're willing to take on additional debt in order to grow Well, the internal growth payout is just a measure of how much we can grow based only on our addition to retained earnings. So we'll look at the internal and sustainable growth for our ProofRock company. So first is the dividend payout ratio. This is cash dividends divided by net income. So we have a cash dividend payout of 33.3%. That gives us a retention ratio, which is the inverse of our payout ratio. That gives us a retention ratio of 66.7%. So that's the amount of retained earnings that we keep for future growth. So 100% of our net income gets divided up. 33% is paid out in dividends and 66% is kept internally. So our internal growth rate then looks at how much the firm can grow assets using retained earnings as the only source of financing. So what amount do we have to add on assets, inventory, property, plant, and equipment, etc., if we only use our retained earnings as the only financing? So the internal growth rate is the return on assets times the retention divided by 1 minus the return on assets times our retention rate. So our return on assets was 13.06% and our retention rate, or B, was 66.7%. So this means that we have a growth rate of 9.54% if we are, that's the maximum possible growth rate per year we can achieve without any external financing. Our sustainable growth rate looks at how much can we grow by using internally generated funds and issuing debt to maintain a constant debt ratio. This is our sustainable growth rate. So this is return on equity times our retention rate divided by 1 minus return on equity times the retention rate. So we already know our return on equity was 18.06% or 0.1806. And our retention rate is 66.7%. So we put those numbers into our calculation and we get a sustainable growth rate of 13.69%. That sustainable growth rate is the maximum possible growth rate we can achieve while maintaining a constant debt to equity ratio. This means that we would not change our debt to equity ratio. If we are willing to take on more debt and not change our debt to equity ratio, that growth rate would be different. We will look more at that debt to equity and the capital structure of companies in a future chapter. What are then the determinants of whether or not we can grow? Well, profit margin, because profit margin indicates how much net income we have. And how much net income we have tells us how much money we have available to us in our equity to increase assets without taking on more debt. We also have our total asset turnover. So this is how well we use our assets, or how efficient we are in using our assets to generate a dollar of sales. Our financial leverage is the choice of our optimal debt ratio, so the debt to equity ratio, and our dividend policy, how much we decide to pay out to shareholders versus how much we retain to reinvest in the firm. So any one of these decisions or things that we do, if we decrease our profit margin, we have less net income available to pay for growth. If we pay more out in dividends, we have less retained earnings to pay for future growth. So we have to maintain a balance of how much we want to pay out in dividends to make our shareholders happy versus how much we retain for growth versus how much debt ratio we want to take on and look at our financial leverage balance. In this table, we can see two different companies, the DuPont analysis for two different companies, Amazon and Alibaba, as they compare to each other and what makes up their return on investment. So we can see that even though they both have about a 15% return on investment in year 2017 and the exact same percent of return on investment in 2015, that their other numbers are very different. For example, Amazon's profit margin is much smaller than Alibaba's. So for every dollar Amazon generated in sales in 2017, they kept 2.3 cents. But for every dollar that Alibaba created in sales in 2017, they kept 27.6 cents. So you can see how the total asset turnover and our equity multiplier and our profit margin are big components of that return on investment. It helps us to do this DuPont analysis to get a further picture of what comes into that return on equity. If we just looked at the return on equity numbers, we would think the companies were pretty comparable for return on equity. But we can see when we expand that out in the DuPont model that it's actually a much different story. So why do we even evaluate financial statements? For multiple reasons. One is internal use. We use it for performance evaluation. We use it to compare how divisions are performing. We use it for management compensation. We use it to plan for the future, to estimate how things are going to happen in the future. There are also external uses. Bankers, creditors, investors use this information to decide whether or not they're willing to give us money. Our suppliers will use this information to determine what kind of credit terms they're going to offer us. We saw earlier in our presentation that the company from the textbook is taking on average 94 days to pay their suppliers back for credit sales. Most suppliers don't want to wait 94 days to be paid. So if we're looking to establish contracts with the future suppliers, they might see that and not be inclined to take us on as customers. Our customers might look at it, and our stockholders are absolutely going to be looking at our financial statement information to determine what kind of a good investment we are. In benchmarking, we compare our information to ourselves. So in trend analysis or time analysis, how we are changing through time, how we are performing from one year to the next, how we're performing over a 5 to 10 year period, and to compare ourselves with similar companies within our industry. So within our peer group. Now, comparing two competitors can be difficult. Some of those reasons is because some companies own multiple subsidiaries that work in different industries. So if we have a company that owns a retailer and a restaurant, it's difficult to compare them to other retailers because they have very different information. The same with all retailers are coded as retailers. So when we see these SIC, which are the standard industrial classification codes, which are US government codes used to classify a firm by its type of business operation. Those codes are available on page 74 in your textbook. We also have the North American Industry Classification System, which is the NAICS code. However, these codes are very broad. So we have retail codes where Target, Walmart, Neiman Marcus, JCPenney's, Yonkers, all of these stores would have a retail code. Macy's, um, so any store that is selling inventory. Now we know that grocery stores, which Walmart and Target have components of a grocery store within them, are going to have different benchmark comparison than retailers selling clothing or fashion. And so it's sometimes difficult to compare within the same industry. And that brings us to our next slide, which is problems with financial statement analysis. One is that we might not have readily available comparison, and that is because our company is made up of multiple things that we have bought that don't have a competitor or don't meet within the same thing. So this is where I was talking about if I own both retailers and manufacturers and grocery stores and restaurants, they all operate within different industries. So comparing myself as a whole with another company as a whole, it would be difficult for me to find another big corporation that owns that same mix of businesses. Global competitors. So financial statements that are calculated not using US GAAP. So that also comes under different accounting procedures. So if I'm in another country and I'm using that country's GAAP, so each country has their own generally accepted accounting practices, or if I'm using IFRS, the International Financial Reporting Standards. Those are different than US GAAP. So the financial statements might not be as comparable because of those different accounting procedures within different countries. We could have different fiscal year ends. I know that comparing different retailers, if we look at maybe Nike versus Adidas, Nike's year end happens in May, while Adidas's year end happens in December. So it might be difficult to compare when we look at one has essentially had 6 months into the new year, 5 months into the new year, while the other one doesn't have any information in the new year. We can have differences in capital structure. We can also have seasonal variations and various one-time events. I think financial statement analysis is going to be extremely interesting in the next couple of years as we deal with companies following the effects of COVID-19 and what kind of difference that has made to various companies. Some companies have really increased the amount of sales that they're doing, while other companies have greatly struggled with multiple of things. So it will be interesting to see in the next couple of years how COVID impacts companies' financial statements. Other differences with financial analysis could be whether we use LIFO, FIFO, or weighted average in our inventory evaluation. Those inventory numbers, if we have a company using LIFO, are going to be very outdated inventory numbers versus a company with FIFO. So how those differences can make financial analysis really a struggle. And then we talked about some other things throughout the chapter, like with the current ratio, where if we get cash from a long-term loan, that can make our current ratio boost up when it was just an influx of cash, but now our debt ratio has changed. And that is chapter 3.